This is TradeFlow News, bringing you relevant news and insights from around the world. TradeFlow News, enabling trade for SMEs and economies worldwide.
These are some of the key topics that we will be looking into in today's program.
First, let's take a look at the overnight headlines which are impacting the commodity markets.
U.S. President Joe Biden's decision to pause expansion of American liquefied natural gas, LNG, exports has raised pressure from environmental groups on the British Columbia and Canadian governments to do the same, although following suit may be politically difficult. British Columbia, BC, will hold an election in October, and its left-leaning New Democrat government is expected to decide late this year whether to approve Ksi-Lisem's 12 million metric ton export facility. It would become Canada's second-largest LNG terminal and also requires federal approval. Both the provincial government in BC, where the projects are located, and Prime Minister Justin Trudeau's federal government have set targets to cut greenhouse gas emissions by 2030, and the LNG facilities could complicate those goals.
Oil prices bounced back in early trade on Tuesday, following a more than 1% drop the previous session, as escalating geopolitical tensions in major producing region in the Middle East fueled supply concerns. Brent crude futures rose 17 cents, or 0.21%, to $82.57 a barrel by 04:01 GMT. U.S. West Texas Intermediate crude was up 17 cents, or 0.22%, at $76.95 a barrel. Both the contracts fell over $1 on Monday as a deepening real estate crisis fueled worries about demand from China, the world's biggest crude consumer, after a Hong Kong court ordered the liquidation of property giant China Evergrande Group.
Moving on to the top news in the energy sector.
Russia's Urals oil price rose above the $60 a barrel cap imposed by Western nations on Monday as Brent climbed, while freight rates were relatively soft despite new U.S. sanctions and rising tensions in the Red Sea, traders said and Reuters calculations showed. The U.S., other group of 7, G7, countries and Australia imposed the cap last year, seeking to reduce Russia's revenue from seaborne oil exports as part of sanctions prompted by its invasion of Ukraine. Under the terms of the cap, suppliers of the Russian oil are only able to use Western services such as shipping and insurance when Russian crude trades below $60 per barrel.
The main impact from the escalating tensions in the Middle East and the threat to ships transiting the Red Sea isn't on crude oil prices. It's refined fuels that are most at risk. The missile attack on the product tanker Marlin Luanda on January 26 by Yemen's Iran-aligned Houthi group underscored the risks to shipments of refined products between the major trading regions of Asia and Europe. The tanker was carrying Russian naphtha and was under charter by global trading group Trafigura, which has subsequently said it is assessing the security risks of further Red Sea voyages. Next, we have the top news in metal markets. The London Metal Exchange, LME, is studying Hong Kong as a location to expand its global metal warehouse network, 5 sources with knowledge of the matter said. Hopeful success there might open the door to mainland China, its ultimate target. Registering warehouses in China, the world's largest consumer of industrial metals, to store metal traded on the LME has been a strategic aim since Hong Kong Exchanges and Clearing bought the LME in 2012 for $2.2 billion. In a presentation made to the LME's Warehousing Committee in December, seen by Reuters, the exchange said companies in the region had indicated interest in Hong Kong as a place to store industrial metals as an alternative to mainland China.
Iron ore futures edged lower on Tuesday as concerns over the indebted property sector in top consumer China countered optimism from the country's recent efforts to contain a deepening crisis and shore up market confidence. The most traded May iron ore contract on China's Dalian Commodity Exchange was down 0.15% at 995 yuan and 50 fen, $138.70 a metric ton, as of 0215 GMT. The benchmark March iron ore on the Singapore Exchange was 0.21% lower at $135.15 a ton, as of 0220 GMT. Denting sentiment, concerns resurfaced over China's struggling property market after a Hong Kong court on Monday ordered the liquidation of property giant China Evergrande Group, the world's most indebted developer.
We will now look at the top news in the agricultural sector.
The European Commission on Monday raised its forecast for European Union stocks of common wheat, or soft wheat, at the end of the 2023-24 season as upward revisions to harvest production and imports boosted supply. In monthly supply and demand data for cereal and oilseed crops, the Commission increased its projection of EU soft wheat stocks at the end of 2023-24 to 19.1 million metric tons from 18.4 million forecast in December, though that was still below last season's 19.4 million tons. Usable production of soft wheat from the 2023-24 harvest was raised by 0.2 million tons to 125.9 million, now slightly above 2022-23 output of 125.8 million tons.
That is all for today's news on commodity market. Stay tuned to TradeFlow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at TradeFlow News, which allows you to watch our program on your mobile device or desktop to receive information from there.